Let's get to Brad McFadden, who is founder at Daily Trading, joining us from Sydney. We are setting up for this key event on Friday, this meeting in Brussels. Brad, what do you want to hear from European leaders?
I have no idea what's going to happen on Friday. The key issue for me is what's actually already factored into prices, particularly in European markets. And from the way I see it, another 2008 plus a whole lot more has already been factored in. So I'm not really too worried about what's going to happen on Friday.
Well, Geithner's heading over to Europe with key meetings across the region. We already had a type of a US-style intervention in the past week with this coordinated action by central banks. The amount of liquidity pumped into the system, the fact that swap lines and dollar fundings are being resolved, do you think this makes a difference to the fiscal system?
A huge difference. If we look back to 2008, I mean, look, essentially Lehman's was the icing on the cake. Prior to Lehman's getting in trouble for about 12 months, we had liquidity tightening up. And of course, Lehman's resulted in a massive fall. Now, what's very, very interesting, as we go back to 2008, which is the whole liquidity thing, it's very, very much in the forefront of central bankers' minds. And because we had that, and because they're panicking over what's going to happen if liquidity dries up, I don't think it's going to happen.
Brad, from a portfolio management perspective, Martin Lakos at Macquarie earlier was saying that last week's rally is a reason to be a bit more positive, to start putting money back to work in the stock market, be less defensive. Would you agree with that?
Yeah, I completely agree with it. There's been a very interesting change occur over the last couple of years, particularly in the US stock market. If we take what's happened just in the last 12 months, more money has exited mutual funds. There's been more net cash outflows than there was in the whole of 2008. And combine that, of course, with corporate buybacks. The thing now is who's left holding stocks, particularly large cap stocks in the US. To me, they've reached rock bottom. They're now in the hands of a relative few holders, and that marks a sign usually of a bottom of a bear market.
Which is an interesting context, isn't it? And you put into the backdrop as well what's happening when it comes to interest rates. We know a bunch of central banks have started slicing their core rates as well. But you make this call that we're seeing a potentially explosive inflationary situation in the world, which is interesting because a lot of people are saying it's deflation that's a greater risk right now. So this makes a key difference if you're looking at inflation versus deflation when investing in equities. So explain this to us, Brad.
Yeah, look, a lot what you hear right now going on in the press, etc., is really justification for what's just happened, okay? And of course, when markets go down, they get in trouble, people tend to come out with a whole deflationary argument. Now, what happened last week was a classic example of how paranoid central bankers are of having deflation. Okay, so we're going to have inflation before we have deflation. And for every action there's an equal and opposite reaction. The amount of stimulus, liquidity injections we've seen over the course of the last 3 years, well, eventually it's going to catch up, and that's inflation of equal magnitude to what we saw in terms of the liquidity injections.
Let's talk about what that means for actual investments, Brad, because you're saying some of basically risky assets then are the new safe havens. Which ones are you talking about?
Yes, the irony is, well, the safe havens, what? US treasuries, or treasuries in general. What's the worst enemy of treasuries? Inflation. The other one is the Japanese yen, which is, now Japan's a unique thing. It's running, what's that, debt to GDP ratio of 230%. I mean, Italy's only 120%, and the US is some 90%. So, I would say, you have to be in those securities that's going to keep you ahead of inflation. Inflation's running at what, 4% in the US? What do you get for treasuries? For the 5-year, you're getting 1%, and in the 10-year, you're getting, what, 2% a year, more or less. People don't realise that. So, into equities. The sort of sectors I've been looking at is healthcare, utility sectors, also gold and oil.
Okay, so
And
a
stay
different way
away
of
from
looking
treasuries.
Okay, stay away from treasuries. Well noted. Thank you so much for joining us today. Really interesting to hear a different perspective. Brad McFadden from Daily Trading. Shri.
Karen, thank you.
Thanks so much.
Here's our oil sentiment.